Jai Guruji, Shukrana Guruji. Welcome to this presentation on capital budgeting. Capital budgeting is the process of evaluating and selecting long-term investment projects or capital expenditures. Here we will cover the various methods of capital expenditure evaluation, their benefits and drawbacks. The broad benefits of systematic capital expenditure evaluation, the risks of not undertaking the systematic project evaluation, various commonly used methods of capital expenditure evaluation, hierarchical order of evaluation techniques in terms of robustness and complexity. Net present value, the most widely used evaluation method. NPV formula, its benefits and limitations. Internal rate of return, the widely used metric to compare the different projects. IRR formula, its benefits and limitations. Modified internal rate of return, its concept and formula, how it improves the IRR formula, conflicts between IRR and NPV, concept of probability distribution of metric like NPV/IRR, the benefits and limitations of probability distribution approach to calculating the financial metrics like NPV and IRR. Capital budgeting involves analyzing the potential profitability of projects to determine which ones are worth pursuing and allocating financial resources accordingly. Capital budgeting decisions are crucial for businesses as they involve significant financial commitments and can impact the company's future growth and profitability. Importance of capital budgeting. Efficient allocation of resources. Businesses have limited capital, and capital budgeting ensures those resources are directed towards the investments with the highest potential return. Informed decision making. By analyzing future cash flows and potential risks, capital budgeting techniques provide a data-driven approach to investment decisions. Long-term impact. Capital projects often have a significant impact on a company's future profitability. Capital budgeting allows for a comprehensive assessment of the long-term financial implications of potential investments. Risk management. Capital budgeting incorporates risk analysis, enables businesses to identify and evaluate potential risks associated with the investments. Improved communication and alignment. The capital budgeting process often involves collaboration between different departments within a company. It fosters communication and alignment between finance, operations, and marketing teams, ensuring everyone is on the same page regarding the investment priorities. Performance measurement. Capital budgeting establishes a benchmark for evaluating the performance of investments after they have been implemented. The hierarchical order of using capital budgeting techniques typically follows a progression from simpler to more sophisticated methods. This hierarchy reflects both the increasing accuracy and complexity in decision making. Here's a commonly accepted order. At the bottom is payback period. The payback period is a formula to calculate the years taken to recover the initial investments. The focus is on liquidity, how quickly the investment could be recovered. The strengths, simple and easy to compute. Weakness, ignores time value of money and cash flow after payback. Next is discounted payback period. Calculates the payback period after considering time value of money. The focus is on liquidity plus time value of money. Strengths, improves upon the payback period by considering the present value. Weakness, still ignores cash flows after payback period. Next is IRR, the internal rate of return. The internal rate of return is the discount rate that makes the net present value of a project zero. Focus, the rate of return on investment, that is on the percentage basis. Strengths, the time value of money included, intuitive return-based measure. Weakness, could be misleading with non-conventional cash flows or multiple IRRs. NPV, the net present value. It is the difference between the present value of cash flows and the present value of cash outflows over a period of time. Focus is on value addition to the firm. It's in absolute value. Strengths, considers all cash flows and time value of money. Aligns with shareholders' wealth maximization. Weakness, requires accurate estimation of discount rate and the future cash inflows and outflows. PI, the profitability index. The focus is on value per unit of investment. The net present value is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. In general, the projects with a positive NPV are worth undertaking, while those with a negative NPVs are not. The net present value of future cash flows are calculated using an appropriate discount rate. This is the formula for the net present value. CT is the net cash inflows during the period T, where T varies from 0 to T. Whereas C0 is the total initial investment costs. So then the cash inflows of each year is discounted by the rate. The rate is the discount rate or the cost of capital. And T is the number of time periods. The discount rate may reflect your cost of capital or the returns available on the alternative investments of comparable risk. As cost of capital is always positive, so dollar today is more valuable than the dollar received tomorrow. So the future cash receipts are discounted. The net present value provides a direct measure of value added to a firm. However, the discount rate to be used may be difficult to find, considering complex cost of capital calculations. This considers a single point cash inflows and does not consider the uncertainty associated with cash inflows. The NPV method is not very useful in comparing projects requiring different investment amounts. So the NPV method needs to be supplemented with IRR/MIRR method. However, this is the most widely used technique to evaluate capital expenditure as it estimates the actual estimated net cash inflows. The internal rate of return is the discount rate that makes an investment's net present value of cash inflows equal to 0. So the higher the IRR, better is the project. IRR is very useful in comparing profitability of projects of different sizes. This is the formula for IRR. All the cash flows of each year is discounted by the IRR, and IRR is such that all the net cash flows, the value of the net cash flows is equal to 0. However, IRR has an unrealistic assumption that all cash inflows are reinvested at the IRR. This assumption is unrealistic. If IRR is very high, above 20%, as companies may not have sufficient alternate investments giving such high returns. The table shows IRR calculation of 21% based on the cash flows shown in the column 2. This is the column 2 showing the cash flows associated with the project. Column 4 shows the amounts to be received on year 6 at end of project if each year's cash flows are invested at IRR, adding up to 6,28,000. If this 50,000, 45,000 all are reinvested at the IRR of 21.02%, you get these figures, and those add up to 628K. Column 5 shows the IRR calculation based on initial cash outflows of 200K and year 6 of total cash inflows of 628K. This column shows the IRR calculation. In the first year, there is an outflow of 200K, and on the 6th year, you have 628K of inflows flowing in from this column. The IRR in column 5 is same as in column 2, thus showing the assumption of cash inflows invested at IRR holds good. If we calculate IRR based on column 5, we get 21.02%, the same as the IRR computed here, and it's also at 21.02%. Therefore, IRR is never used on a standalone basis and is used in collaboration with other methods in selecting a project. Modified internal rate of return removes the deficiency of IRR by assuming the cash inflows are reinvested at a specific rate, thus making it more realistic measurement tool. The formula of MIRR is mentioned. This is the formula. The numerator is the future value of positive cash inflows at the reinvestment rate. The denominator is the present value of negative cash flows at the finance rate. Let's evaluate what is the new IRR of the same capex proposal if the cash inflows are reinvested not at the IRR but at the discount rate of 12%, the estimated cost of capital. The column 3 indicates the amount to be received at the end of period N. The inflows are invested 12%, adding up to 506K. This is the column 3, and these are the cash inflows associated with the project in column 2. Now, if the amounts mentioned in column 2 are reinvested at 12% at the cost of capital, then you arrive at these amounts, and these amounts add up to 506K. Column 5 shows the IRR calculation based on two items, that is cash outflow of 200K at period 0 and inflow of 506K at the end of period 6. So this is the column 5. Here the IRR is calculation on just two items, that is the present value of cash outflows, which is 200K in the year 0 and 506K in the year 6, which flows from this column. And we arrive at an IRR of 16.7%. The IRR falls to 16.77% from 21.02% of the previous calculation. The MIRR calculation by the attached formula gives the same result of 16.77%, which is a realistic figure. That is, if we calculate this, make the calculation by this formula, it will give the same figure of 16.77%. Now, higher the difference between IRR and the discount rate, more is the difference between IRR and MIRR. If the IRR is higher than the discount rate, the more front-loaded the cash inflow is, higher is the gap between IRR and the MIRR. When evaluating mutually exclusive projects with IRR and NPV, it is possible to witness a conflict wherein one project has higher NPV and another has higher IRR. If two projects entail different capital expenditures, then NPV should not be used for comparison, as NPV of bigger project is most likely to be higher. The table shows cash inflows of two different mutually exclusive projects. Project 1 has absolute net cash inflows, but the inflows are front-loaded. Thus, it has a higher IRR than project 2. Please refer to this table. This project has lower net cash inflows, but since the cash inflows are front-loaded, this gives a higher IRR than this project 2. Where the cash inflows are higher, but the cash inflows occur mainly towards the end. So this results in lower IRR. The MIRR is calculated at 12% reinvestment rate is almost same for both the projects. The second table shows the NPVs of two projects at different discount rates. It is evident that for discount rate up to 10%, project 2 has higher NPVs, and for beyond 10%, project 1 has higher NPV. This shows the NPVs of project 1 in 1000K in K and project 2 in NPVs of project 2 in K. Up till 10%, project 2 has higher NPVs. From 12% onwards, project 1 has higher NPVs. If the company has a discount rate less than 10%, then it should choose project 2. For all of the discount rates, it should choose project 1. At a lower discount rate, a project with larger backloaded cash flows may have a higher NPV. Let's see, initially, this red line indicates NPVs from project 1 and blue line indicates project 2. Let's see, initially this blue line lies above red line, that is till 12%. Till 10%, and then onwards from 12%, this red line lies above blue line, that is project 1 has higher NPVs than project 2. Let's see, the red line lies above blue line from 12% onwards. Both NPV and IRR provide single output values and do not consider the uncertainty associated with the future cash inflows. As the actual IRR to be realized from a project is bound to be different from the projected one, so there is almost 100% confidence level that IRR calculated at CAPEX evaluation stage is incorrect. So a better CAPEX evaluation method should provide a probability distribution of IRR, NPV, and other financial metrics. The Monte Carlo simulation provides that probability distribution of financial metrics. It works capital expenditure evaluation process in the following manner. Identify uncertain inputs like sales volume, raw materials, price, project cost, etc. Each selected uncertain input is assigned a probability distribution like normal distribution, triangular distribution, log normal distribution. Use softwares like Python, Excel with add-ins to simulate thousands of scenarios. In each scenario, input values are randomly sampled from their distributions. For each iteration, model computes NPV or IRR. Output is probability distribution of IRR or NPV. The standard output of such an evaluation process is mean IRR NPV, standard deviation of the IRR NPV, confidence intervals of IRR NPV, say IRR at 5th percentile, which indicates that at least IRR appearing at 5th percentile will be achieved in practice with 95% probability. Now, Monte Carlo doesn't give a single yes-no answer, but rather helps visualize and quantify the uncertainty around the financial metric to enable risk-informed decision making. Let's visualize two mutually exclusive projects whose probability distribution of NPV as given by Monte Carlo follows a normal distribution. However, the distribution of NPVs given by Monte Carlo may not be normal in real world if the input prices are not normal, and the NPV distribution needs to be empirically checked. Project A has a lower mean NPV but has a lower standard deviation compared to project B. So which project to choose by a company? This is a table. The mean NPV of both the projects is given. Project A is lower at 10 and project B is higher at 13. Standard deviation is also lower in case of project A at 3% and project B at 5%. So this shows the 5% confidence level. What is the figure? What is the expected mean? That is around 5.07%, and for project B it is lower at 4.78%. And at the 95% confidence level, it is 14.93, it is 21.22. It's understandable since project B has higher standard deviation and higher mean, so it is more spread out than project A. The return distribution of project B is more spread out than that of project A. So in such cases, which decision a company will take, which project a company will choose. Since this is at 5% confidence level, so this indicates that there's a 95% probability of the actual NPV being higher than this amount. Whereas since this is at 95 confidence level, so this has only a 5% cumulative probability of the NPV being higher than this. So a risk-averse company will obviously choose project A, as the cumulative probability of achieving this return is around 95%. And this return is higher, whereas an aggressive company might choose this project B as there's a 5% probability of achieving such a high return of 21, which is much higher than this. So an aggressive company might choose project B. This is a return per unit of risk. Here also project A gives a higher figure. This is a kind of Sharpe ratio, which is the risk-adjusted return. So a project A, a company which uses the risk-adjusted return method should choose project A. Generally, an aggressive company would opt for project B, higher mean and higher 95 PL NPV. Companies taking risk-adjusted decisions should prefer project A. Thus, there is no one single best method of capital expenditure evaluation. But a company generally uses a combination of method as per the needs of the company and makes a selection based on risk-reward consideration. So this concludes this presentation. Thanks for watching. Jai Guruji, Shukrana Guruji.